Imagine walking into a supermarket. You see hundreds of brands, different logos, different colors, and different slogans. It feels like competition, like dozens of companies are fighting for your money. But what if they aren't? What if many of those competitors have the exact same owners? Now zoom out. The food you eat, the apps you use, the banks holding your savings, the companies building your house, the media you watch, the medicines you buy, behind thousands of these businesses. The same names keep appearing, not because they're secretly running the world, but because a surprisingly small group of investment firms owns significant stakes across enormous parts of the global economy. These firms rarely make headlines. They don't manufacture phones. They don't sell burgers. They don't build cars. Instead, they own pieces of the companies that do. And together, they manage trillions of pounds worth of assets. So here's the question. How much influence comes from owning just a few percent of thousands of the world's biggest companies? Today, we're uncovering one of modern capitalism's most misunderstood realities. How a small group of investors came to own pieces of nearly everything, and why understanding this changes how you see money forever. Level 1. The Hidden Ownership Network. Let's start with a simple idea. Ownership. When you buy shares in a company, you own a tiny piece of it. One share may not matter much, but millions of shares? That's a different story. Now imagine owning shares in hundreds, then thousands, then nearly every major public company. That's exactly what large asset managers do. Companies like BlackRock, Vanguard, and State Street. These firms don't usually own companies outright. Instead, they own significant minority stakes on behalf of millions of clients. Those clients include pension funds, governments, universities, insurance companies, charities, and everyday people saving for retirement. If you've invested through a pension, there's a good chance your money is invested through one of these firms. That's because they specialize in managing investments at an enormous scale. The result? They appear as major shareholders in thousands of publicly listed companies. Open the shareholder register of many Fortune 500 businesses, and familiar names appear again. Airlines, banks, technology companies, healthcare giants, retail chains, energy firms. The pattern repeats. At first glance, it feels strange. Why would the same investors own competitors? Because their goal isn't choosing winners, it's owning the market itself. Instead of betting on one company, they spread investments across entire industries. That reduces risk. If one company struggles, another may thrive. For investors saving over decades, diversification often beats guessing. This is the foundation of modern investing. Simple, efficient, powerful. But it also creates something unexpected. Common ownership. Level 2. The rise of index investing. This story really begins decades ago. For years, investing meant trying to beat the market, picking winning stocks, timing crashes, predicting the future. Most people failed. Even many professionals couldn't consistently outperform. Then came a revolutionary idea. Instead of trying to beat the market, why not buy the whole market? This became index investing. Rather than choosing individual companies, an index fund buys shares in every company inside an index. If one business falls, others may rise. Low fees, broad diversification, long-term growth. It sounded almost too simple, yet it worked. Investors poured in, year after year, decade after decade. Today, trillions of pounds are invested in index funds. As money flowed in, asset managers bought more shares. Not because they wanted control, but because they had to follow the index. If Company A represented 4% of the market, the fund bought roughly 4%. If Company B grew larger, the fund bought more. This created a snowball effect. Successful companies attracted more investment. Growing funds purchased even more shares. And the largest asset managers became even larger. Here's the fascinating part. Most people never noticed. Because nothing dramatic happened. No hostile takeovers, no dramatic boardroom battles, just millions of ordinary people investing for retirement, one monthly contribution at a time. Tiny decisions, repeated by millions, creating one of history's largest concentrations of financial ownership. Level 3. Does ownership mean control? Here's where things get interesting. Many people assume if you own shares, you control the company. Reality is more complicated. Let's say an investment firm owns 8% of a business. That's a lot. But it doesn't automatically mean they dictate every decision. Companies have boards of directors, executives, independent shareholders, regulators, corporate governance rules. Major decisions involve many participants. However, large shareholders do possess influence. They vote on important issues: executive pay, board appointments, corporate governance, long-term strategy, climate disclosures, shareholder proposals. When a firm manages trillions of pounds, those votes matter. Executives notice, boards listen. Not because someone is issuing secret instructions, but because large shareholders represent significant ownership. Think of it this way. Imagine owning 8% of your favorite football club. You don't choose every player, but your opinion carries weight, especially when combined with other major investors. This is why institutional investors meet regularly with company leadership. They discuss risks, performance, capital allocation, future plans. The goal isn't running daily operations. It's protecting long-term investment returns. That's an important distinction. Influence is not the same as absolute control. Yet influence at massive scale can still shape corporate behavior. Level 4. When the same investors own competitors. Now, we reach one of the biggest debates in modern economics. Suppose the same investors own shares in 2 competing airlines, or 2 supermarket chains, or several major banks. What happens? Some economists argue this creates common ownership. Instead of investors wanting one company to crush another, they benefit if the entire industry performs well. This has sparked years of academic research. Some studies suggest common ownership could reduce aggressive competition in certain markets. Others argue the evidence is mixed or inconclusive and that there are many other explanations for pricing and market behavior. The debate is ongoing. What is clear is this: large diversified investors generally prefer stable, profitable businesses over risky corporate battles. For example, imagine 2 companies start a price war. Consumers may celebrate, but profits collapse. If you're invested in both businesses, that doesn't necessarily help your portfolio. This doesn't mean investors tell companies to avoid competing. There is no universal evidence of that. Competition laws and corporate governance also play important roles, but it does raise fascinating questions. How does ownership shape incentives? Can financial structures influence market outcomes? These are questions economists continue exploring, and the answers affect everything from airline tickets to food prices to internet services. Level 5, the real lesson for ordinary people. So, should this scare you? Not at all. In fact, there's an ironic twist. The same system that creates enormous institutional investors also allows ordinary people to build wealth. Think about it. When you invest in a broad market index fund, you're doing exactly what these giant firms help facilitate. Instead of relying on one company, you own tiny pieces of hundreds or thousands. You're benefiting from global economic growth over decades. This approach has helped millions build retirement savings. The real lesson isn't that a secret group controls everything. The lesson is that ownership matters. Most people spend decades working for companies. A much smaller group owns parts of those companies. Employees exchange time for income. Owners receive a share of profits. That's one of the biggest mindset shifts in wealth building. The wealthiest people often focus less on earning and more on owning. Owning businesses, owning shares. Owning assets that produce value. Because assets can continue generating returns long after today's work is finished. This doesn't happen overnight. It usually happens slowly, through consistent investing, patience, compounding, and decades of discipline. The financial system may seem intimidating, but understanding ownership gives you a completely different perspective. Instead of asking, "Where do I work?" you begin asking, "What do I own?" That single question can completely reshape your financial future. Conclusion. The modern economy isn't controlled by one mastermind. It's built on an intricate web of ownership. Millions of investors, millions of pensions, millions of retirement accounts, all flowing through a surprisingly small number of giant asset managers. These firms became powerful not because they manufacture products, but because they manage capital on behalf of others. Their influence is real, but so are the limits placed on that influence through corporate governance, regulation, and market competition. Understanding this isn't about believing in hidden conspiracies. It's about recognizing how money moves, how ownership works, and why capital has become one of the most powerful forces shaping our world. The companies making your phone, your food, your medicine, your entertainment may compete fiercely every day. Yet behind many of them stand investors seeking something much simpler: long-term growth, steady returns, and the power of diversification. The biggest surprise isn't that a handful of investment firms appear across thousands of shareholder lists. The biggest surprise is that almost anyone can participate in the same system. The difference isn't access, it's awareness. Because the people who understand ownership often see the economy differently. They stop seeing brands. They start seeing balance sheets. They stop seeing products. They start seeing assets. And once you understand who owns the world, you begin asking a far more important question. What will you own in the future?